Hey guys, welcome back to my channel, and today we're going to be going over my TFSA portfolio because it's a Monday video. And after that, we're going to jump into an exciting topic. We're going to be talking about Canadian technology IPOs and why they're down, the IPOs that happened in 2021, by 2.4%. We're going to dig into all the facts here and try to figure out what's going on with Canadian IPOs, especially in tech, and what should we expect going forwards in the future. It's been a very interesting topic to research about because I myself have invested in many IPOs this year. These IPOs include Kits Eye Care, D2L, as well as Magna Forensics. And some of them have shot up quite a bit, while others are down quite a bit as well. Before we move on, this video is brought to you by Cantech Letter. And Cantech Letter is one of my favorite news sites to get news on Canadian technology stocks, especially more of the smaller cap stocks, because they actually do pieces on companies like Well Health Technologies, CloudMD, and they even do pieces on Shopify. They talk to analysts and have a very analytical approach, and that's what I really appreciate about Cantech Letter. So if you want, you can check out the link down below and sign up for the newsletter. It's completely free, Canadian, and they focus on the stocks that I like to invest in. Now let's not waste any more time and jump into the Excel spreadsheet. So starting off here with portfolio metrics, the current market value of my portfolio is $9,723.51. Unfortunately, this week, Friday was a terrible day where the new variant of the virus was exposed in the media, and we saw a massive drop on Friday across the entire market. So this week, my portfolio is down by 2.1%. On the bright side, my portfolio is still up in the green by 4.69% or $435.37 since March 16th, 2021 when I started this portfolio. Compared to the index, if I were to have bought the index instead of all the stocks I bought in this portfolio, my portfolio is down by 2.29%. Now, if you want to pause the video here and just check out the rest of the statistics of my portfolio, feel free to do so. Moving on to the transactions. This past week, we'll scroll down here to see what I bought and sold. So I didn't actually sell any stocks. However, I made a bunch of purchases. Last week in the video, I mentioned I was going to purchase Well Health Technologies, and sure enough, I purchased Well Health 1, 2, and 3 times for a total of 21 shares. The average price of Well Health Technologies that I bought was around $6 or maybe $5.90. I bought 10 shares at $5.80, 5 shares at $5.79, and 6 shares at $6.20. The other stocks that I bought were Air Canada, 2 shares for $22.10 and 1 share for $21.20. And this is on Friday when fear struck the market. I told you guys in a previous video, maybe 3 weeks ago, that Air Canada, their earnings, they were spectacular, so the stock had a pop. However, I did believe it was a short-term thing because we're not still fully out of the pandemic yet. And obviously, I couldn't have predicted that this new variant was here, but I did have an inkling of a feeling that Air Canada was coming back down. And I said that I was looking to purchase Air Canada between the $20 and $22 range. Well, here it was, and I purchased some Air Canada stock. It's very possible that next week Air Canada can continue to drop, so stay tuned for that, and I might be buying more shares this coming week. On top of that, I also bought 2 shares of D2L at $16.85. In this company, I do believe in long term, and I've been picking up shares pretty much every single week. I also had a limit order fill on the 22nd for $16.68. So I guess this week I bought a total of 5 shares of D2L. Going over to the entire portfolio, it looks pretty bloody if you look at the 1 week performance. Only 4 stocks or so are actually up, whereas the rest of them are down. If we sort by the 1 week performance, the worst performers were Air Canada as well as Kinaxis. Not really sure why Kinaxis is not doing so well because there still is this whole supply chain problem and everyone needs their technology. But they are coming off of all-time highs. So maybe there's just a sell-off into the technology sector. We also see Enghouse here in the same technology sector down by 5.4%. So it's possible that maybe it was just more of a technology-wide sell-off. Sun Life here is a stock I'm actually starting to look into and maybe picking up more shares. It's come back down to around $69 per share. But I'm interested in Sun Life when it drops to about $65, and we were seeing a bit of a downtrend. So I will be watching the stock this week, and maybe I'll pick up a share or 2. The other stock that I'm looking to add a bit more to this portfolio is Dollarama. And Dollarama has been teetering around the $52 mark to $60 mark. And every time it drops down to like $52 or $53 per share, that's when I continue to scoop up more. And that's honestly the great thing about dollar cost averaging is the fact that when you buy into these stocks, you're not buying all at once and you just get to see the price action. And if you see a stock trading range bound, then you know at certain points, those are the high points and likely the stock will start to fall from there. This is definitely not guaranteed, but it's possibly a way to swing trade. And maybe I'll consider doing a little bit of that later on in this series. There is one stock that I'm planning to possibly try swing trading with, and that's DCM. Now, if you guys have been watching my series and are inspired to invest and want to do dollar cost averaging, then the platform that I'm using for this portfolio is Wealthsimple Trade. And that's honestly, in my opinion, the best brokerage for you to start today. If you add $150 to your account and start trading with that, you can get an additional $50 by using my link down below. So the idea to talk about Canadian IPOs came from when I was looking at my portfolio and trying to figure out why are some of these IPOs that I invested in not doing so well. And I started to go down the rabbit hole and things got a lot more interesting. So at the beginning of this video, I stated that Canadian IPOs are down on average by 2.4%, whereas the entire TSX market is up around 10% from when I started the series in March. And if we look south of the border, they have a lot of exciting technology IPOs, and on opening day, they shoot up by triple digits. Sometimes they go up by 2 or 3 times. So what's wrong with the Canadian markets? Are investors not getting that technology is a future? Well, let's dive into this. The first point that I'm going to make is that the Canadian markets before in 2019, it was largely finance, which made up about 30% of it. Mining stocks, which is around 9%. We've got industrials making up around 10 or 12%, as well as utilities making around 9%. These were the top sectors, and a lot of these companies in these sectors are blue chip companies. And if you look at the type of investors that we have in Canada who are investing in the Canadian market, well, they're basically like your mom or dad who like blue chip companies, as well as the pension funds, which hold your mom and dad's pension. And pension funds like to keep it safe. They want to make sure that the capital that these hard workers put into this pension fund will not go down the drain and be wasted on some penny stocks or gambling. So they make sure to invest in blue chip companies which have had a good record of producing cash flow as well as a positive net income in the past. And it's only millennials and the younger generation that's really into this technology boom. And right now, the young generation in Canada, we don't really have much money to invest, let alone we probably have a lot of student debt as well to pay off. So investing is like the last thing that we have on our mind. Now, the US markets are very different from the Canadian markets, and I'll talk about that a little bit later on. The second point that I'm going to make is that all these Canadian tech stocks on the IPO, they're usually under $1 billion or sitting around $1 billion. However, the large cap companies in Canada, these companies like banks are in the tens or hundreds of millions of dollars. So the size of these technology companies that are IPOing are very small compared to the rest of the market. And because the rest of the market is made up of your parents and your grandparents, and they're the rich ones here, and they're not interested in technology stocks, then there aren't that many buyers out there for these technology stocks. Initially, they have their huge IPO hype and you see a lot of volume. A few days later, the volume drops dramatically. And that's when we get people like market manipulators or hedge funds coming in to manipulate the price and cause it to either drop dramatically or skyrocket for no real apparent reason. There isn't any sort of news piece that has come out that shows huge promise for the future. The company's stock just kind of rockets up. For example, Magnet Forensics. When I was invested in the IPO, I didn't understand why it went from like $17 on IPO day to about $55 or $56 a couple weeks later on. There was no crazy news. Yes, the company was profitable, but why don't we see a huge pop on the day of the IPO? I think there's definitely some sort of manipulation going on here because the Canadian markets were not as developed as the American markets, where it's a lot easier to do things like spoofing, matched orders, wash trades, as well as marking the close. If you're interested in knowing how these work, then go ahead and do a Google search on them. Now earlier I said I was going to talk about the US markets and how they're very different from the Canadian markets. And the first thing is US markets are a lot larger than Canadian markets. They have a lot more international investors because the US markets are the largest in the world right now. And lately, the US markets have been booming because of technology stocks. And the top 5 companies in the States are pretty much all technology stocks. And because the largest cap companies are dominated by these technology stocks, well, who benefits from this? the employees of these technology stocks. They obviously got options when they signed on to become an employee, and the ones who got in really early became multimillionaires or maybe even billionaires. And the fact that these guys have all this money, and the thing that they understand best is technology, well, where are they going to invest their money? In another technology stock. So for that reason, I think that all this money is staying in technology because it's the fact that the rich get richer. And if all they understand is technology, what's the point in them trying to go outside of their circle of competence and invest in things like mining, biotech, finance? It just doesn't make sense for them to move outside of technology, especially because how well technology has done in the past 10 years. If you look at the companies who have increased the most in the past 10 years, I guarantee you these are technology companies. Companies like Apple, Amazon, Tesla. All these companies have 10x at least in the past 10 years. And if you look at other companies like JP Morgan, J&J, all these other more blue chip companies, these companies maybe have doubled or tripled. However, they have definitely underperformed the technology stocks. So basically, all these rich technology workers have put back their money into technology stocks, continuing to drive up prices of technology companies. And there also is good reason for other people to get into technology stocks, because technology is innovative and it helps us become a lot more productive. And the way that you can scale technology is unparalleled compared to other sectors out there. For example, if you build a piece of software, you can send it 5 million times around the world within less than a day. But if you wanted to create a new canned good and you think it's the most nutritious thing and everyone would benefit from that, well, it would take you years to manufacture that, to build that plant and all the other logistics around it to get that product in the hands of other people. So technology really has an unfair advantage. And with the rich in the United States mostly being tech workers, this is why we see a lot of technology stocks booming on IPO day. Now here in Canada, the difference is our technology sector is not as mature. If you look at the different statistics, in 2019, technology stocks only made up about 4% of the Canadian markets. But things only go up from here. In 2020, technology stocks made up 6% of the Canadian markets. So we saw a 50% increase. And then in 2021 January, technology stocks made up 9% of the Canadian markets. And today, as of October 31st in 2021, technology stocks made up about 10% of the Canadian markets. So technology stocks are definitely rapidly increasing in Canada. Also, another fact that you should know is that from 2019 to 2021 in January, the number of technology stocks pretty much stayed the same. It was sitting around 50 or 53 companies. Oh hi, Future Daniel here. I forgot to add the fact that the number of stocks, it did stay the same, however the value of these stocks increased 3 times. Only recently in the past 10 months or so, the number of technology stocks increased from 54 at the beginning of 2020 to 70 right now. So we had about 16 Canadian technology stocks IPO'd. The current value of all these technology stocks is $424 billion. But the funny thing is, more than half of this is actually made up by Shopify, who has a market cap of $253 million. So I think Canadian technology right now is maybe around 5 to 10 years behind the US market. But going forward, there's a lot of exciting things, in my opinion, for the Canadian technology sector. We definitely have a tech community building up here, and me being a tech worker, I'm seeing that. And there's a lot of immigrants who are moving from California, and these are high-skilled workers, to Canada. So I do still have high hopes for the Canadian technology sector. Yes, the performance wasn't great in 1 year. However, that's a very short-sighted way to look at this. Investing for me is at least 3 to 5 years out. And yes, I do adjust some of my stocks, but for the most part, a lot of the companies that I invest in, I hold for the long term. So if you're sitting there looking at your Canadian technology stocks and just thinking, what have I done? I'm down so much. Well, you're not alone. I'm also there too in some of my positions. What you have to do is make sure that you understand the business, how the business is going to be able to turn their product into cash, and eventually at the end of the day, what really matters is the bottom line. Is this company going to be able to make money? And if they can, I think you can sleep well at night. But that requires your due diligence and your research. And if you're interested in learning a bit more, I do have a free course on Skillshare with their 14-day trial. You can find links down below for that. I hope you learned a lot from this video, and if you got any questions or comments, leave them in the comments section down below. I'll throw up a couple videos on the screen here. If you're there, I'll see you there. If not, keep up the grind and have a great day.